Welcome to Wednesday Night Live and the Educated Homebuyer Podcast with myself, Jeb Smith, and my esteemed mortgage professional, Mr. Josh Lewis. We are here to answer your mortgage and real estate questions while updating you on everything that's happened in the economy, everything that might impact you as a potential buyer or seller out there in the market. So this week, we got a lot of data coming out. We got jobs reports today. We had some data yesterday. We got non-farm payrolls later in the week, which we're going to discuss all in today's episode as we dive into some charts. But Josh, how are you today? You were telling me a story before. Is this a story you can tell me on the air?
It's marginally interesting to those of you watching at home. Had a listener to the podcast reach out. Been listening to the show. He says, "Hey, sold my house, buying a new house. Realtor hooked me up with a lender, and so far the lender's done a really good job. Available. Had a call at 10 o'clock Sunday night. Dialed in the numbers, got them the pre-approval letter. They got their offer accepted." He says, "I'm looking at these numbers. I don't know if it's a good deal, or bad deal." So about 2 minutes ago, I just get it and take a look, and he got one loan estimate from the person, not a comparison, not multiples, and it has him paying 3.5 points.
Ooh.
And I've not got an answer to this question yet, but my question was, did you ask for the world's lowest rate? Did you ask to pay $12,000 or $11,000 of points to get the world's lowest rate? And it's doubtful because I've never had a borrower say, "Hey, what I want to do is buy the world's lowest interest rate." So if you're getting that, is it appropriate to show you a number? Hey, here's what's possible if you wanted to give up a bunch of your money from your bank account to buy a low interest rate. It's appropriate to show that. You need to have a baseline, a 1 or a 0 point option, so you can see what's in the ballpark. So for those of you out shopping, please make sure that you're not getting crazy quotes like that are hard to compare against what the actual market is doing.
There you go. Good story to start tonight's episode. What we generally do if you're new here is we go through some charts. It takes 10 or 15 minutes or so. But it's a good time to start putting your questions in the chat now so that when we're done with those charts, we can flow right into your questions. Also, love to know where you guys are watching from. I know we have a lot of regular viewers that show up every single week, and I'm thankful for you guys, like Dixieland in Minnesota every single week. But anybody else, let us know where you're watching from. It's always a helpful for us because a lot of times we have questions about those markets too, and maybe you can help us out because we're located here in Southern California. But without further ado, Josh, let's take a look at some charts as we always like to do. We like to start with inventory because it kind of tells the tale. Inventory's up 32.8% year over year. We went from 787,000 single family homes last week to just over 800,000, sitting at 803,000. The expectation is a peak somewhere around 843,000 at some point this year. We're not that far off from that, but we will continue to watch it and update you as we move forward. This next chart is looks a little different this week because we took our data and we actually aggregated them into our own charts. Thankful for ChatGPT for being able to do that. Not quite as pretty as I want them to be yet, but we'll get them there. But this just shows us 23, 24, and where we are in 25, both in Orange County and here in Huntington Beach. Orange County sitting at 4,523 homes. That's a decrease of just less than 1% week over week. Huntington Beach sitting at 291, also a decrease about 1% week over week, or just under 1% week over week. Actually, a lot less than 1% week over week, but it's down, which again, time of the year, this is about pretty close to when we would see the peak, not that far off. But the reality is probably not going to happen this year with where rates are and inventory coming to the market. I think we had 8 listings come to the market today in Huntington, new listings, Josh, and we're still sitting lower than we were last week. So
including the beautiful one you sent me?
Including that, actually, was that on the market today? I don't know how I got that. Did that come? I don't know if that got sent to me in an email or I came across that one on. No, it was a new listing. It was a new active listing. So always watching the inventory. But, and again, this is, depending on what day of the week you pull data, the numbers are going to be a little bit different. But we always pull them on Wednesday. So we're consistently Wednesday over Wednesday. Now we look at new listings. So as expected, new listings did dip this week, but it had a lot to do with Memorial Day. We talked about that last week. Seller activity still remains ahead of last year. And we're still seeing 5 to 10% more listings than the same week in 2024, which again, nothing that's completely out of the ordinary, just based on what's happening out there in the market. Weekly pending sales sitting at 68,000, just over 68,000, which is basically showing that there is demand even with rates hovering above 7%. And then the idea is that once rates go down, which at some point they're likely to, that we're probably going to get more transactions, more people coming to the market. Total pending sales looks 413,771. That's up 2.6% from last year. And next week we'll likely see an increase just to how that data is aggregated over that holiday period of Memorial Day. And then new or actually percent of properties with price reduction sitting at 38%, which is essentially where we've been for some period of time. So we're getting close to probably more of a sideways move than that acceleration up. But again, we watch this every week and we will continue to update you. So Josh, one of the big things that came out today was ADP leads the week. It's or leads the jobs reports rather. It's always comes on the Wednesday before the Friday non-farm payrolls. So we're continuing to see, disappointing numbers, if you will, on that front, but it doesn't necessarily mean that's going to translate.
Well, we call it Jobs Week for a reason. It's a whole week full of data. So it starts with job openings, a labor turnover survey, which was yesterday. Today we get ADP. Tomorrow we get the weekly claims. And then Friday, the big one is non-farm payroll. So let's kind of look at all of them. So JOLTS, as you can see from mid-2023, has been basically a straight line down. For a few months, towards the end of last year, September, October, November, the job openings started trending up. People were like, maybe we've seen the worst of it. And then we've resumed that trend down. So this is probably kind of the new normal. I don't necessarily expect them to keep trending down. And this is also a little bit of cloudy data. Post-COVID in work remote world, a lot of jobs get posted around in multiple places around the country. So interesting to watch the data, but kind of settling in at a new lower level. This is a breakdown of it. The cool part, the aqua there at the bottom kind of shows you quits. So people who are voluntarily quitting, they've ticked up a little, had ticked up a little bit here recently and then back down. Layoffs, discharges, and other, meaning employers, are they holding on to their employees? And that has ticked up. So the last couple of reports, we had less quits, a little bit more layoffs, and less job openings. So it's telling us softness, but not necessarily weakness. And the reason why we talk about this, Jeb, is there's two things that the Fed is looking at right now in terms of what's going to lead to higher or lower rates in the future is jobs, the employment market, and inflation. So when we look at this tells us, is there slack in the market, meaning wages are going to stay under control, or is there a really tight labor market where wages are likely to spike, causing inflation? So as you were saying, we got the ADP figures today. I threw that red line in there because it kind of shows where we were throughout 2024, a couple months a little lower, a couple months a little bit higher. But here in the end of 2024, early part of 2025, it was showing a little bit of strength, but we really just fell off a cliff here the last 2 months. Not only was last month a disappointingly low number, it was revised down from like 62,000 to 60,000 and came in, what was the number today, Jeb? 32,000, a very, very, very low number. So it's still expanding. We're not showing job losses, but not the robust job creation that you need to keep keep full employment as the population expands. So this is why we look at this. The big one that actually moves things. There's a little bit of sometimes predictive power in what happens with ADP on Wednesdays, but not a huge correlation. So as we can see, the last 2 months have been low, or the last 4 months, we had a couple of really low months on the monthly jobs report. And we're getting that Friday, and it's expected again right at around 130. If it comes in much below 130, you will see improvement in bonds. If we get one of these blockbuster surprises where you go back 5 months, we're in January, February, we got that report, a couple months that were stronger than expected, and you saw rates sell off. So it's kind of big. It's an important one to say Friday what happens. So we got some additional data in here. Jeb, we got the ISM services PMI, and you can see it's been steadily trending down. It's at 49.7, I think was the number. Under 50 is contraction. So that's the first time since way back in what, mid 2024 that we've been below that. So it bears watching. It just tells you the services component of our economy is the biggest section. So if job growth is weak. You see contraction in the services section, tells you that you're going to see weakness in the economy and more unemployment. We watched this, Jeb, here, threw this up last week, and the green box I had there is where we were a week ago. A week ago, this was up over 2% at 2.08. Truflation, it's an instant read on inflation. They take together all of the data that is available. It has a high correlation to CPI. So they're at 1.92, but that's down from 2.08 last week, which is important to see because a month ago we were at 1.45. So over 3 weeks, we went from 1.45 to 2.08. We had a really strong downtrend that was looking like in the next 3 to 6 months, we were absolutely going to hit the Fed's preferred measure at 2% on the preferred measure of PCE. And the tariff stuff definitely has us in a gray zone here where we don't know exactly what's happening next, but at least we kind of broke that run up of 3 or 4 weeks where the instant read on inflation was up. This is the Cleveland Fed's nowcast on it. And as you can see, not much has changed on the core PCE and CPI for the next 2 months. They're expecting 0.21, 0.22, 0.23, 0.24. So that's under 3%, but not a lot. Under 3%. We want those numbers. You have to average 0.17, I think it is, for the 12 months, month over month, to hit that 2% target. So still elevated. The one that I put in red, it just shows, tells you that for June, they're expecting the core CPI to go up. But if you see the month over month isn't going to go up or isn't projected to go up, but the year over year will, it tells us we have a really low base month falling off from the prior year. This one, Jeb, I thought was important. You can see those two lines moving pretty closely to each other. It's the US dollar index versus the 10-year yield. And what that tells us there is that they usually move together very closely. But over the last several months, or at least since Liberation Day, they have diverged. So the dollar has weakened, which usually leads to lower interest rates, and we haven't seen this. I don't expect those to separate. They're going to converge one way or the other. Dollar can strengthen, 10-year can come down, they can meet in the middle, or just one or the other can converge back to the other. But I would expect the 10-year to come down. I don't know that I'm expecting additional dollar strength. This has to do with the tariffs. In general, when the U.S. is importing a lot of stuff, we've seen imports down the last 2 months because of the tariffs. So we bring goods in and dollars go out around the world. Generally, when those dollars go out, they go into treasuries, or a lot of it gets invested in treasuries. So that would tell us why we haven't seen strength in the 10-year. It could be another thing among all of the issues with the tariffs that are causing inflation there. Jeb, this is a shameless plug for the episode of the podcast that we recorded today. Redfin over the last 2 weeks has been out with some spectacular clickbaity headlines. There's some truth to them. They're not manipulating the data. I guess they are manipulating the data. They're taking data and they're presenting it in a way that makes it look other than what it actually is. But this chart here, I thought was interesting in 2 points. The chart itself that Liz Saunders posted, and then Ben Hunt threw an interesting comment there. What that chart is saying, unsold housing inventory is worth a record $698 billion. Well, I drew the green trend line on there. It wasn't there. So if you look, Redfin going back to 2012, when they started gathering the data, they said this is the most dollar value of homes that have ever been on the market. Well, if you have a linear market that just goes up every year and you have the same amount of homes on the market every year, you're going to have a higher dollar amount. And the year-over-year changes, the 2-year or 3-year change back to January of 2022 is amazing, because that was when we hit the bottom of the number of homes listed for sale. So we had a very low number. Since then, we've seen more homes come to market and home prices continue to go up. So of course, we're going to arrive at a higher number. But Ben Hunt's comment here is interesting because we talk about stagflation. What is stagflation? It's a weak economy with inflation at high levels. Well, we actually are seeing stagflation, as he pointed out here, in the housing market. So this is what stagflation looks like. No one is distressed enough to lower prices to clear market. So what the doom and gloomers want to tell you is that there's going to be all these distressed sales that are going to pull prices down, and you'll see a correction to where market prices should be, and then we'll get kind of back to normal and we'll have the next move. But the issue is you don't have distress. Everyone has tons of equity. Everyone has low interest rates. They're just posting up going, hey, what comes next? But then rates are too high to spur buying, meaning affordability is too low to spur buying. So what you have, stagflation isn't fire, it's ice, just a long gray slog of reduced volumes and economic activity. And I thought, Jeb, that was a pretty good description of where we've been here recently. Threw a couple charts in here. Just to show, Case-Shiller was out, I think, on Friday with their month over month, and they actually showed a decrease in the seasonally adjusted home prices month over month. It was like 0.2% negative, so not a huge amount, but interesting to show. That is a paired sales index, a repeat sales index, which we say is much better than looking at median numbers. ICE had their numbers come out earlier this week, and they showed plus 1.6 year over year. I had the number here and see if I can find it quickly. Because up 0.1% month over month. So essentially we're looking at, depending on whose numbers you look, whose paired sales analysis, you're looking at a relatively flat market. For those of you who love politics, we'll bring it in here just because I thought this was interesting. We've heard a lot of talks about the big, beautiful bill, tax cuts good for everyone. The crazy thing is the lowest 20% of people will pay more taxes under this if it goes through the way it passed through the House. The second quintile also going to pay more. Everyone else saves a lot of money in taxes. And that is what is known as trickle-down economics. The theory is, hey, these are the people that spend money and keep the economy going. Even if you're in that second quintile, you make $50,000 a year, you need the guy that makes, up here in the top quintile, you need him to buy the car that you sell, or the car that you repair, or whatever your product is. So this is what the theory is, that you put more money in these people's pockets. I would say that there's a lot of people in these lower quintiles, and I don't know. It wouldn't be that expensive if we're looking at increasing the deficit here, which is what leads to higher interest rates, or some of that fear of that leading to higher interest rates. I don't know that we need to be putting what amounts to relative pennies in that top tier's pockets. So with that, Jeb, I didn't put the 10-year chart in today. I did the 5.5 MBS mortgage-backed securities, just so you can see we had a really nice rally today based off of that ADP data, which you can see in the big green candle over there to the right. We ended up clearing all of the moving averages except for the 200-day, and we've still got another 30 basis points. So almost another 1/8% better on interest rates before we hit resistance there. So in the short run, things look good, but it's all dependent on what happens Friday. Day over day, rates were down about 1/8%, similar over the week. So from that perspective, you're safely under 7% for people who are well qualified, good credit scores on the conventional FHA and VA, back into the 6 3/8, 6 1/4 range.
All right, guys, that puts us into answering your questions. So if you have questions about any of the charts, you can put that in there as well. But we'll start diving into some stuff here in just a minute. We've got Cleburne and Little Rock coming in. We've got Tundi in Little Rock as well.
We have
Little Rock.
two people. We could start.
Are you guys in the same
Rock
house
meetup.
watching on two different computers, or what? Heather again from Inglewood, always one of our regulars coming in. Looks to be everybody that's let us know. But Walter came in with one of the first questions, Josh, and said, "How fast can a refinance? And when is it reasonable to do it?" So how fast can I refinance?
Walter didn't like his original question, and he came back and improved upon it. How fast can you refinance? When is it reasonable? Locked in and closing on June 16th. Info on the house, $268,000. FHA 0 points, $11,000 in closing costs. It's important to remember, I highly doubt that you're paying $11,000 in closing costs. That's closing costs and prepaids. Prepaid interest, taxes, property taxes, homeowners insurance at closing. So it's just mentioned 2487 all in. So we got a couple things we want to look at. It's an FHA loan. Most likely when you refinance, you're going to want to do an FHA streamline. With that, you have to have 210 days have elapsed from your first payment. So you're looking about 7 months before you're able to do that with a streamline. If you want to go to another loan type next month, you could do that. So that tells us how much do we have to save before it makes sense. $268,000 loan. If we use our rule of thumb, take 125,000 divided by 268,000. We need a little less than 0.5%. But remember, for an FHA streamline or VA IRRRL, we have to save 0.5% in interest. And if you see those numbers, you will probably want a little bit more than that, especially depending on where you're at. So, Walter, what I would say is, if you're not already on the rate watch list, get on it. Send me your mortgage statement. Once you get one in a few months, we'll put you on there. We'll keep an eye on it and let you know. But with an FHA, you're going to need to have it for about 7 months. You're going to need to be able to drop the interest rate 0.5%. If you want to switch to other loan types, you can do it immediately as soon as it makes sense, assuming you qualify.
All right. Here's a good question, Josh. Slow motion for me. Anyway, Jeb, do you find that home orientation affects demand or pricing? For example, a southern facing backyard that gives you greater sun exposure, or on east facing backyard that gives sunrise views. I do think it matters, but less than most people think, or I think it matters to a smaller percentage of people than you would think. How's that? Here in Huntington Beach, facing west is, with where the sun's going, some people like that. Some people like to be facing east so that you get the sun over the house, rising and setting kind of in the same orientation. So it depends on where you are in relation to some of these things. I think it has a greater impact. But typically speaking, there are cultural things out there where certain cultures, only want houses that face south or whatever reason. So some of that stuff plays into feng shui and some other things. But for the most part, I think it's a smaller percentage of people that care, but they should care when it really does impact, if that makes any sense.
I will say this, Jeb. I think it's property specific. I think of this like around Huntington Beach. It doesn't make much difference. We get similar sun. We don't have that super intense.
We don't have a sun anymore, Josh. It doesn't.
Well, it's June. It's June. We don't have sun for at least another 30 days. But with that, it's similar no matter where you're at, and it's not super intense where you're worried about that afternoon sun just beating in your house. My place out in Rancho Mirage, it makes all the difference in the world. So every street in there faces one direction or the other, north, south, east, or west, the way everything's oriented. And the direction you face makes all the difference in the world. Ours faces directly at the mountains, which is what you want. And you can be in different places in different directions and look out and see it. But I'll tell you, it's probably a $50,000 difference in where we're at if you have the best direction that you're looking versus the worst. So there's some that are kind of acceptable, but that's specific, right? That is an area where some people are adamantly want morning sun or don't want afternoon sun, any number of those things, and then also the views. So it really, to me, unless you have the cultural stuff, which is a whole horse of a different color, it comes down to the specific property.
What I will tell you is that most agents have no idea which way a house faces and can't tell you where the sun rises and sets. If that
right here, Jeb, it sets right at
Josh,
right here in Josh.
There you go. So I think if it's important to you, ask the questions. But there are definitely yards that don't get sun in the afternoon and don't get the right lighting. So that stuff matters. And it should be talked about. But I think it rarely is in many cases. Question coming in from Corbin. What do you think of Grant Cardone saying that if interest rates go down, more properties will come to the market, which will inevitably bring down home prices? Just throwing a random question. I think you should look at what Grant Cardone has said over the last couple of years and then make your own thoughts on what he thinks. Grant Cardone's big in the commercial world. When it comes to residential property, I don't really take anything he says. It doesn't really have an impact on the day to day. I do think interest rates coming down does add more inventory to the market, but you have to understand anybody adding their property to the market's also a buyer, right? So if you're putting one on, you're taking one off the market. So is that going to push prices down? I don't think so. But with that said, as rates come down, all of those buyers that don't own homes are now sitting on the sidelines waiting for their entry point to come in. So any available inventory that the sellers who's putting one on and taking one off, they're now attacking that other inventory on the market. So I don't know. I don't think there's a world in which you get both lower rates and lower home prices, but let's just say that, anything's possible. I don't think it's likely.
Let's underline what you just said, Jeb. If you were going to sell and not be a buyer, you're not waiting for lower interest rates to do that. You're just going to sell the house. Sure. I mean, unless you have some theory that it's better for you to sell, you'll get a higher price waiting for lower interest rates. So those people that are waiting for lower interest rates to sell are by definition buyers. So there's no additional net inventory. There's a little bit of logic in here in that I think it caps appreciation going forward, despite the fact that there could be more demand coming in, because more demand should be met with a little bit more additional supply. So we should be closer to that supply demand balance, which kind of goes back to that theory that we've talked about for a while, Jeb, that we could be in for lower than normal appreciation for an extended period of time, because it's unlikely that we get a quick knee jerk bottom drops out of the market correction.
Agreed. We've got Linda coming in saying that she's closing next week. Interest rate is quite high. I know you don't have a magic 8 ball, but when do you think rates will fall to the mid 6% range, Josh? 6 to 12 months? Question mark.
I appreciate you guys saying, hey, that we don't have a magic 8 ball or a crystal ball or any of that stuff. But like literally, we could be there next week. If you had a really, really terrible jobs report, something happens positive on the tariff front, we're not so far from mid sixes. I mean, we're at 6.875 today. To see a 3/8 move within a week, that happens fairly regularly. Now, I'm not calling for it. It's just going to be dependent upon the data, and we need weak data. So it's funny. We talk about in the mortgage industry, and for borrowers of any sort, we're kind of vultures. You want bad things to happen. I was actually reading a market report today, and they're saying we're hoping for a weak jobs report on Friday. Like, that is a crazy thing to root for, right? Shouldn't we want everyone to have jobs and low unemployment and everyone gets raises? We do, but there's consequences to that, which is higher interest rates. So if we continue getting weak data, if the tariffs play out over the next 30, 60, 90 days and prove to not be as inflationary as people fear, you could absolutely see it get there. The converse there is also true. Like if inflation starts ticking up, you could see the 10-year at 5% and rates at 7.5%. So very, very hard to say. It's absolutely possible. At this point, to me, it's a coin toss, and there's really no point in trying to wager or guess.
All right, we got Miguel locked in at 7.5% conventional, waiting on a new build to be completed, asking that if rates were to tank tomorrow, could his interest rate be adjusted to the lower rate even though he is already locked in?
7.5 conventional. I'm wondering if we got a really low credit score or what the heck is going on there. I would love to know more about this, but yeah, if rates drop, so this is what we like to say. Some lenders, very few out there, say you can lock and then you can get a free float down. There's no free float down. The cost of those free float downs is factored into the probably subpar pricing that you're getting to begin with. But every lender doesn't want their entire pipeline to float out the door or fly out the door if rates drop. So in general, this is what a float down policy that's pretty consistent across the industry looks like. Rates need to move in your favor 100 basis points, which is about 1/4% in interest. So rates have to drop at least 1/4%. If they drop 1/4%, you're going to get about half of that. You would be about 1/8 of a percent better. The eighth is about a cost of the float down. So now if rates move down 0.5% and a cost of 1/8, now you're getting 3/8 of that. So by all means, there is a cost to hedging loans. Lenders do want and need and expect you to honor the terms of your lock. But if the market moves significantly, they also know that you can pick up your loan and go somewhere else, and they will work with you to keep the loan in their doors.
All right. There was another one in here I saw, Josh, that I was going to click on here. Jordan, does it make sense to buy directly from a local builder and not involve a realtor? I bought 2 of my last homes from the same builder and saved $8,000 by going directly through them. So typically a builder isn't going to give you less money because you go directly to them, at least not in my experience. But builders typically will pay compensation to a buyer's agent. So I think having a real estate agent is important, even with new construction. Understand when you go buy a home from new construction, you're dealing with the builder who's building the property. They've hired their own real estate agents to represent them, their own mortgage people to represent them. They have their own contracts that they've created to basically represent their best interests. So why wouldn't you want a kind of a third party, so to speak, that has your best interest in mind, right? You're assuming that by going to the builder that they've got your best interest in mind. And the reality is Builders are in the business of making money. They're in the business of building homes, a lot of times very quickly, without attention to detail in many cases. And so I think having a good agent on your side that understands new construction, knows what to look for, can walk you through some of the process, maybe knows some of the intricacies, if you will, of the contract. Just all of that stuff I think matters. And typically you're not going to get savings by not having an agent, and you're not going to get charged more by having representation. So I don't think it makes sense not to have them. But to each his own. You got to do what's right for you. It's somewhat. I mean, it looks like I'm saying that because I'm a real estate agent, and the reality is, I think it's important to have somebody on your side that's representing you. If I were to go in and buy new construction, I would have somebody represent me. How's that? And I'm an agent. So just my 2 cents. All right.
I have my license. Can I represent you?
Yes. Yes, you can. Do you anticipate home prices slightly on the upside or flat other than seasonality declines? Josh?
Here in SoCal. So the answer to this one to me always comes back to tell me what happens with interest rates, and I'll tell you what happens with home prices. So what we're seeing, we're in what should be the heart of buying season, the closing, and seeing increases. And you saw essentially flat, depending on whose measure you choose to look at on a month over month. The year over year is still up. Most of the year over year projections looking forward are still up. But that's been with rates in the high sixes. When we were in the early part of the spring, it was shaping up to be a good year, not a great year, not gangbusters, but that was rates at 6.625, maybe a little lower and trending down. People were ready to step into the market. As we got up to that 6.875, 7%, now we're kind of flattish. So if you tell me rates go higher, we're at 7.25, 7.5. I think home prices for the most part are going to come down. Now, if you tell me we're at 6.5 or below, they're going to trend up. And if you get a big move and you get under 6%, which most people aren't expecting or calling for, at least in 2025, you would see not double digit, not even 5 or 6%, but you would be seeing more appreciation than most people would expect. So until we get that clarity, get the uncertainty out of the way, and get some idea of what's happening with interest rates, it's really hard to say what happens.
All right, here's a question from Anshu. Says, with the 10-year yield dropping today, should we be hopeful for a 6.5 30-year fixed ARMs, or just a blip like other instances? Quick action. So basically, I think here's the easy way to calculate is, I think at the moment you probably have to use a spread of around 2.4%. Just add that to wherever the 10-year is, and it should give you a pretty good idea of where interest rates are. So if we're saying spread today is 2.4 and you're saying the 10-year today is at 4.3 something, that's going to put you, 6.75-ish% on interest rates. And I think, without going too deep into that, Josh, pretty fair for a well-qualified buyer out there, 6.75.
Yeah. So if you look at that, that's for the best qualified borrower. Yes.
Sure.
And bigger loans. I mean, realize if you're getting a $200,000 loan, those can't be super thin deals, or the lender just can't afford to do them. Unfortunately, the economies of scale come into play at the bigger purchase prices. But yeah, so 435 and called it, like you said, a 2.4 to get down to 6.5. You need somewhere close to a 4% 10-year treasury. Is that likely? I mean, we're not that far from it. I mean, heck, we were there.
Yeah, we were there.
We were there 2 months ago. Like, this isn't unprecedented. This isn't crazy. It's been there and likely to be there again. And this weird volatility may be the new thing going forward. Like, look what we've had so far in the stock market this year, right? We had, hey, it looks like it's gonna be another great year. Oh my God, everything's falling off the cliff, and we're finally getting this monster correction to back at all-time highs. So from that perspective, maybe we're in a newer era of volatility where, to Anshu's question, we're saying, he tried to catch that last dip and we just kind of missed it. And he has a big loan, so he doesn't need as big of a move, and there won't be as much cost-wise on a percentage basis. So we just need to keep an eye on it. I definitely think a 30-year fixed under 6.5 is possible. But we definitely do need to be nimble and jump on it when it becomes available.
Yeah, and one thing we've talked about in various episodes over years here is that, the traditional spread between the 10-year and the 30-year was somewhere around 1.7%. So we're at 2.4%, which is almost 0.75% higher than it should be. So if you had a normal spread right now, you would have interest rates at 6%. So, as the 10-year comes down, that spread is going to normalize as well. So you're going to kind of get, you're probably going to get a little bit more bang for your buck as the 10-year starts to decline. Some of that volatility comes out of the market. But what you need is reassurance with data. Like, lenders aren't going to, the spreads aren't going to normalize until lenders know that this is kind of the future of where rates are going to hang out, because otherwise they get screwed with people refinancing as rates move, et cetera. So just know that at some point it will normalize. Is it going all the way back to 1.7? Maybe not. I mean, maybe 2 is the new number. We don't really know because it hasn't been normal in a couple of years. So just know that, we're here watching it every single week. We're here updating you every single week. So, continue to follow along. We could be of assistance. I'll put a link scrolling the bottom of the channel right now where you can talk to Josh or myself, depending on whether you're trying to get pre-approved, you're wanting a second quote on a loan, you want to be on the rate watch list. All of, that link will get you in touch with Josh and myself, and we can guide you through that process. Also help you find real estate agents depending on where you are. So Anshu came back and said, thanks a lot for covering the query and well-rounded explanation. So thank you for being here.
Okay. I got a good one for you, Mr. Jeb.
All right, let's hear it.
Smart Fox would like to know, is this year or next a good time to upgrade? Thinking buy and buy a bigger, better, more expensive home. Seeing good inventory lately in South OC, but will need contingency to sell existing. So a little complicating factor there. It's not just the simplicity. They think they want to go contingent versus putting something, getting their home sold and getting something on the market.
Sure. Is it a good year or time? I mean, depends on what you're doing, what you're looking for, the right time in your life. I hate saying that every time, but I mean, here's the thing. Take me back to 2023, October of 2023. Looking back at that time, interest rates were above 7%. Home prices, again, were at all-time highs. People were saying it's not a good time to buy. I bought then. Fortunately, I've been able to refinance twice since then, bring my interest rate down. But, my home price is up, I don't know, 12, 13% since I bought in October of 2023 in my neighborhood. So in hindsight, it was a great time to buy. Looking at it at that time, we didn't really know. Now, here's what I'll say. Like Orange County, I think we're in a good spot for the most part. There's always demand here, depending on what you're looking for, what you're trying to upgrade to, and how long you're going to be there. I think if you have a longer term time horizon, very little impact. But I think you're not going to see a big decline in prices, but you're also not going to see a big ramp up in prices either, unless interest rates go way down. So I think if you can find the right house and you can get a reasonable amount for your house, based on what you're trying to do, I think, yeah, absolutely. Because I do think there are opportunities out there in the market. As far as the contingency goes, what I'd love to see you do is, if you're even thinking that, start talking to agents now, get your home on the market, see what kind of activity you're getting on your house, and then you can make the decision whether or not it makes sense to buy something else. You should already know that, hey, if this thing sells, this is what I'm doing. But what I find oftentimes is somebody calling me like this is like a client, and they're like, Jeb, we just saw a house this weekend at an open house and we want to make an offer. And I'm like, okay, so what's the deal with your house? Well, it's not even on the market yet. That's a problem. You need to be
We're
on the
going to list
market
next weekend.
Ideally, you're in escrow, or you're in a position where you don't need that to buy. In your case, you're contingent. So I think talking to an agent now, having that conversation is a good first step. If you need somebody, would love to help. But if not, and looking for somebody specifically in your market, let me know. Happy to refer you to. But either way, I think having the conversation is a smart thing, just to see where you're at and then make decisions from there. All right, Josh, that's the end of the show. No, not really. But there's no more questions, guys. Start putting your questions in there. If you're finding any value, do us a favor, hit the thumbs up. Consider subscribing to the channel. We're still trying to grow this channel, believe it or not. We're at 6,400 something subscribers.
Almost 7,000. So if you haven't
7,000.
subscribed, or if you're on Jeb's channel and you don't know the podcast exists,
there you go.
you can run over and subscribe.
You can run over and subscribe. And the goal here, again, to continue to educate. If you find value, share it with somebody, right? The best way to get a podcast seen or heard is by people sharing it with other people. And if you find value, chances are the people that you refer it to will as well. So that would be helpful, and we would be thankful for you doing that.
Jeb, we do have the eternal question has arrived.
eternal
Willing
question.
always has questions for us, and he, she, they are here and said,
Maybe we should ask Willing.
We've got conflicting
pronouns.
information directly from Willing. So if they said their pronouns were he or she today, I would not believe it tomorrow.
You know, I'm saying he's made several references to go with the he pronoun. So that's what we're going to go with. That's what I'm going with. You can do whatever you'd like. But
okay,
anyhow,
we're going to come back to that because Wesley just offended me. Wesley says, I don't know enough rich OC dudes to share this podcast. We do loans throughout the country. We've got a Tennessean right now. We've got one more open in Virginia. We got Florida.
Josh,
so
tell them your average purchase price, the average income. We just ran all these numbers, guys. So we know our avatar to some extent on deals that are being closed. So what's the average credit score, Josh? Or what's the
average credit score is about 730. So under 740, but pretty close to 740. So good, not the greatest, but good credit. And that's largely because it skews younger. So I think we were right in when we talk about the average age of a first time buyer, where they're saying it's 38. We're under that. I think it's 34, 35 was the average age. We had most are couples. Shocking, right? Dual income.
And income was 200-ish.
It was not. It was lower than that. It's
Between
like 135, 145. Because remember, lots of people buying in Texas, $300,000, $400,000 house. Buying in Florida, $250,000 house. Had a listener here in South Carolina that made a poor decision, but they're buying a nice little home for $250,000. So there are parts of the country where you can get a good property at a really low price, and those will skew those numbers. But what I say, you and I were just talking about this, Jeb, when we look at the people that are successfully buying, it fits a certain area. They're above where the median income is. So we looked at the national median, which is not a super useful number, but it's $86,000 household income. Definitely skews higher than that. But whatever your region of the country, if you know what that number is, I'd say it's probably 130, 140% of the median is about what our average borrower in that area looks like. What I was going to say that was kind of interesting, most are dual income, multiple households, but we have just as many single women as we have single men. They're almost equivalent amounts of each. So, I will say one of the other things that's became interesting to me over the last 5 years, of the two buyers together, more and more women are the financial heads of household. Not that they make more money, some of them do, but that they run the finances. They're the ones that know what's in the checking account. What do we have in our 401k? What do we want? So definitely some changes over the last 20, 30 years.
All right. Budget with twins. Do you think Trump's big, beautiful bill he wants passed by July 4th will do anything to mortgage rates like his tariffs did in April? I don't know that it's going to impact. I mean, obviously, with any sort of budget bill, it's going to raise the deficit. And I think most of that's probably already factored in at this point, unless something goes completely bananas. So I don't know that it's going to have a real impact on mortgage rates, personally speaking. Again, we keep going back, employment and inflation. That's what's going to impact mortgage rates more so than anything else, and volatility, right? So if we can get kind of a realistic idea of where inflation is headed with tariffs and everything out there, and employment can get stable, then you can have a better idea of where rates are headed. But I don't see this one having a huge impact. Josh?
I appreciate Elon stepping up. I mean, we go back to to me, the most important issue in the election last year was who are we going to elect and what are they going to do about the deficit? And I think Trump won on that. He came across as having more of a plan. What we're doing so far is not executing on that plan. And by default, politicians are not incentivized to stop spending money. They use public money to buy votes. So red, blue, whatever side of the aisle you're on, that's the reality of it. So we keep electing people who do not take seriously that we cannot spend money we don't have. And even look at the issues in the headlines. Anything that Doge cut, what was the reaction? Someone goes, well, you're killing babies, you're starving puppies. Like, they're not easy choices. We've run through the numbers here on the show. There's no easy choices for reducing the deficit. So something's going to have to go that someone is going to find valuable and important. It doesn't mean that they're not. It means that we don't have the money for it. So until that gets under control, Elon stepping up this week and using X and his pulpit to say, hey, this is a terrible bill. We need to do what we said we were going to do, come in and reduce this deficit. I think that will help getting it modified a lot. And you saw a few more senators and Republicans stepping up, or Republicans in Congress saying, oh yeah, we can cut at this. It's easier said than done. If it were easy, it would have already been done, right? Democrat, Republican, if it were easy, someone would have stepped up and done it right now. But it is important that someone's going to have to do it at some point.
All right. Carol says, live in an area where homes are selling in days. Contingency is not an option if you have an accepted offer. We are considering a bridge loan to avoid having to move 2 times. Thoughts? I can you afford it? Right. I mean, nothing wrong with bridge loans or any variation of that sort of thing. As long as you understand the implications of what happens if your house doesn't sell as quickly as you think it's going to, and it sits on the market for longer than expected, right? Is it going to put you in a financial hardship? If the answer is no, then I think great. There are some lenders out there that will do loans that allow you to, once you sell, to do a recast, like without, a one-time recast, take that lump sum and take down the loan balance right after closing by selling a house. So there are some different things you can do to set yourself up for success in that scenario if you go that route. But I don't think it's bad, as long as you understand what it is and you're okay and can afford it if something doesn't go as planned. Josh, have you heard about this? What are your opinions on it? It is a homeownership fair. It's happening on June 21st, where buyers can get $218,000 in down payment assistance.
It sounds like someone has a homeowners fair where they're going to pitch mortgage and real estate services. And the only way they can get people in the door is tell them that they have magic purple unicorns that will solve all your problems.
So what I'm hearing you say is that purple unicorns and $218,000 of homeownership grants are essentially the same thing.
They are the same thing. And if they were available, you wouldn't have to go to a homeownership fair to find them. There would be loan officers screaming from the mountaintops that they have purple unicorns saddled up and ready for you to ride.
That may be the best part of the show, maybe ever. That right there.
I'm going to use Sora, and next week we'll come back. We'll have a video showing the loan officer with the purple unicorn saddled up and ready to ride.
That's fair. We are going to bring that to you. So not to be a bunch of jackasses there, Heather, but I think what Josh is trying to say is that there's no world in which that exists. So are there grants? Are there programs out there? Absolutely.
Jeb, I know where you're going, and I want you to finish that, but she's in Inglewood. In Inglewood, there is a purple unicorn out there running wild. So why don't you tell her about it?
Yeah, but it's not $218,000.
But it's still awesome.
It's 20 now. They no longer do the 50,000. So it's 20,000.
Too good to last.
Too good to last. But again, there are grants, there are programs out there in different places that give you additional options. I recorded a video this past week that's going to post on this channel on Sunday about doing FHA at 100% financing. Many of you guys know FHA requires a 3.5% down loan. Well, we actually have a lender that'll go to 100% financing. I'm going to post about it on Sunday on my main channel here, and we'll go over the details, and you can learn about how to do that if of interest. But yeah, that one you asked about is not realistic. So, all right. let's go. Recon asked us to look at their question higher. Do you
I
see
didn't
that
see
somewhere,
one
Josh?
from Recon B. Maybe throw up the one from Mitch Nippenberg, and I'll scroll through and look for it since I know your eyes. Recon B. Okay,
All right,
there we
here.
go. Hold on, I found Recon B's
Well, now I
question.
went in here, dude, and you just
No, we've
overrode me.
told Recon, he, she, they, that we were going to answer their damn question. And here we go. Hi, Jeb. What do you think of buying in the Princeton, Texas area
I
right
don't know
now,
where that is.
given the Highway 380 issues? They really went specific on something you know almost nothing about.
I know nothing about Texas, other than it's a big state, and driving through there from one side to the other sucks. It absolutely sucks. It's the flattest state in the world, and it's hard. It's hard to look at the same thing for 12 hours. But outside of that, I don't know enough to be able to tell you where Princeton is. Here's what I know is that there are areas in Texas where homes are sitting longer. Builders, sellers are doing price reductions because of inventory and affordability and all that sort of thing. I mean, we had a buyer or a seller that was a buyer a couple of years ago here on the podcast last week that they're basically selling their home at the price they paid for it, actually less than they paid for it by about $50,000 because they didn't like the neighborhood they were in. They wanted to move to another part of Dallas suburbs, and they're taking a loss on that property to do it because it's not selling. So I don't know Princeton, but what I do know is with highways and that sort of thing, it can be a potential issue, but I'm not here to be able to guide you. If you tell me where you are, I can hook you up with somebody that probably knows more than I do.
Willing says if it's by Whataburger, the value will be up.
I mean, maybe, I'm not. Are you a Whataburger
I
guy?
am not. Texans love them some Whataburger. Last time I
I'm
went
not a
there,
big
I
fan
got in a
either.
fight with a local Texan that swore it was the greatest burger ever in the history of the world.
I agree. I do not think it is the greatest burger, but that's just me. I am under contract for a new build. This is Mitch, done on July 16th. I have $27,000 in flex cash to use. Any thoughts on how to best utilize? I'm going to put my money to cover closing costs with the rest on rate buy down. I was going to put it on closing costs and rate buy down. So Josh, is that a good use of credits from a lender?
If it wasn't someone else's money, would you go and say, I'm going to use, so say that 27,000 is your money in your savings account. You have the rest of the money in your checking. You go, I got enough in my checking. I could pay everything. Would I use my $27,000 to buy the rate down? The builders have created this sort of area where you feel like it's monopoly money. It's a bonus. I just get to buy the rate down with it. It's true. But unless you need that lower interest rate, I highly doubt that you would do that if it were your own money. And I would use their money to cover all the closing costs, and whatever is left over, buy the rate down as low as I can. We've got different unique situations. If you need that lower rate to qualify, if you don't feel like you're going to be able to qualify for a refinance in the future, you're retiring, getting divorced, any number of things that could impact your ability to qualify going forward. Other things being equal, I would not just take a big lump of cash from the builder and buy my interest rate
down. Yes. Sorry. I was talking to, I referred, did I talk about this on the podcast, Josh, or on the live, that we had a viewer from the show reach out to me a couple months ago? They bought a condo in San Diego a couple years ago, and they needed to sell it, wanted to sell it. And so referred them to an agent down there, that a friend of mine. And it's a unique property in the sense that it's basically a loft. It's a studio, not a loft. It's a studio. So it's small, no real bedrooms in it. It's, basically HOA fee, condo fee is high. Great location, but they're just sitting. But I just got a message. It's been on the market for quite some time. Not really any activity because there's other ones in the building too, and so on and so forth. And this one's not highly upgraded, so on and so forth. Anyhow, they just got an offer. So congratulations on getting that done. But I was reading that text. So it's good stuff. All right. Let's see. Smart Fox, another question. What's the chance that the SALT will be approved and included in the big, beautiful bill? Will that help any mortgage interest if I buy my upgraded home? So Josh, SALT, what's the 40,000?
40,000 is the way it's written now. It may not get through at 40,000, but we're at 10 right now. I can't see it being less than 20. There's bipartisan support, Republicans and Democrats in high cost states that are all over it. There's not a lot of resistance, so it has support. It doesn't have a lot of resistance. 40 is a lot, and it primarily goes to the people at those higher incomes. If you're watching the chart at the beginning of the show, but let's say you get 25, 30 at the worst case, 40 at the best.
Yeah, I mean, but so does that help him in his upgrade?
It could. We have to look at your tax situation. It's a loaded question. You would be able to deduct for us in California, if you're buying a $1 million plus home, your income, and you're doing a full doc loan, your income is high enough that you would probably not be itemizing. In other parts of the country, when you have a $29,000 standard deduction, if you're buying a $400,000 house, even at 7%, that's $28,000 of interest. And then you end up, you like this, Jeb. I just got myself, I'm going to interest, which the interest is just limited by the 750. But if you're in a high tax state and you're making good money, so California, if you make enough money to qualify for a home, you're probably at a 10% tax bracket. 200,000 at 10%, you got 20,000 right there of state taxes. If you're capped at 10, you're losing 10 there. You're not able to deduct any of your property taxes. That $1 million home has about $12,000 of property taxes. So say you've got 33,000 of state and local taxes just with property taxes and your state income tax. So yeah, that makes a pretty big difference there. If you go and have that additional deduction, combined federal and state on 200,000 income, you're going to be at a 45% bracket on the top end. So you're saving a lot of money.
There you go. Good explanation. Josh is not a CPA, by the way, just plays one.
I do the CPA math.
There you go. Don Hinton says, how about purchasing in Statesville, North Carolina, small town, suburb of Charlotte? I actually know where Statesville is.
Where is it relative to Kinston?
It's 4 hours away, man. It's away.
South, east, west, north?
It's west of Kinston. I'm from Eastern North Carolina, about an hour from the coast, hour and a half, maybe most from the coast, whereas Charlotte and all of that is due west. Just take the 40, baby, all the way across and you hit it. So, and if you keep going, you come all the way out here to beautiful not sunny, beautiful, cloudy California. That's where we are at the moment and where we've been for 6 months. Asking about buying there. I don't follow that market closely enough. I know Charlotte has been, done very, very well over the last couple of years for sellers, been harder for buyers. I know prices are pretty stable there. That's about all I know. I have a great agent that can guide you through the process. If you need somebody there, happy to refer you. Let me know. You can use that link at the bottom of the screen, get in touch with me and I can refer you to them. Or if you'd like to talk to Josh about a loan, we could do loans in North Carolina as well. That same link will get you in touch.
Lots of listener borrowers in North Carolina.
I know it's amazing. Miguel came back earlier and said that rate he had was so high in the 7s was on a manufactured home, Josh. So that's probably why rates are higher.
It's possible. It's still a little high depending on the credit score.
All right. We are at that point in the show, a bit on an hour, guys. We appreciate you being here, putting your questions in, letting us talk. Hopefully you are a little bit more educated than when you came in this evening. If you're finding any value, do us a favor, thumbs up, subscribe to the channel if you haven't done so already. Speaking of the big, beautiful bill, Josh, we recorded an episode on the podcast this past week that talks about that big, beautiful bill and the impact on affordability, what it might do. So if you haven't gone to the Educated Homebuyer podcast YouTube channel, check it out. It's on there. You can also listen to it on Spotify and Apple. Go into detail about what was happening at that time, which is essentially where we are at the moment. Nothing's much has changed on that. So check it out. Let us know what you think about it. And Victor has a question, Josh. We'll go with Victor real quick. Are you guys familiar with Modesto, Turlock area? Homes have been on the market for a long time, but they aren't dropping. So any thoughts on Modesto, Mr. Josh?
I don't know where their industry is. Obviously, agriculture all the way through the Central Valley, but beyond that, I don't know what's driving it. But when I read that question, I go, this shouldn't be shocking to most people, because what we've said all along, going back to 2022, when people were screaming that home prices are going to crash, what we've seen is home prices are sticky to the upside for the reason that the homeowner that is in a home doesn't want to accept less. And I don't mean less than what they paid for it. I mean less than what the highest sale in their neighborhood was.
Less than what their neighbor sold their home at.
So what they'll do is they'll go, well, I put the sign out. If someone wants to give it to me, great. If not, I'll just stay here. I will wait until the values go up. So we're going to see some of that, but you would need a realtor that's an expert on the area to tell you. At a certain point, you get to a point, if the market doesn't correct, if affordability doesn't get better, bring in more demand, the people that have to sell, the ones that someone died, they're getting divorced, they have to move out of the area due to a job transfer, they have to liquidate at whatever the market will bear. But people that don't have to sell generally just choose to stay if they don't get a number that they're happy with, which is higher than what most buyers imagine or think it should be.
Good explanation. Quan, one other question, just where are we based? We are based in Southern California, Huntington Beach specifically, but we can help you pretty much anywhere in the United States. So if that's helpful,
including the DMV, if it's a Baltimore Ravens helmet I'm seeing there.
There you go. With that said, guys, we appreciate you being here tonight. Appreciate the support. Until next time, make sure you buy right, borrow smart, build wealth. Adios.
Amigos.